There's seemingly a tug of war between risk on and risk off in pockets of the markets, perhaps best exemplified by trends in both gold ETFs and individual investing flows. For more, joining me now is Joe Cavatoni, Managing Director at World Gold Council, along with Mike Akins, founding partner at ETF Action. Joe, your firm is behind the largest gold ETF. It's up substantially year to date, but you see more room to go higher based on some historical precedents.
That's right. So we are definitely seeing unprecedented levels in terms of interest for the gold market, in particular gold-backed exchange-traded funds. What you talk about, risk and uncertainty, is really driving the investment sentiment. And while people are comfortably continuing to stay risk on, I think they're really starting to get a very significant appreciation for how you need to hedge that, and gold fits that bill perfectly. So using exchange-traded funds backed by gold, you can actually add a hedge, an appropriate offset for when markets gap down or risk is unclear and you need that protection in your portfolio. Year to date, we've seen record flows in both exchange-traded funds in the US, but also in Asia. So the market's a global market and really growing quite substantially.
Yeah, it's certainly got a lot of tailwinds in the hedging department. Mike, you're also looking at gold ETFs as a percentage of S&P 500 market cap. How does it fit into the broader equity picture?
Yeah, I think what's interesting about the gold ETF market as a total, like take out exchange traded funds and take out and just look at like the growth in the S&P 500 and the growth of the total gold market have been very similar over the last years. They both exploded over the last decade, 3x in total market capitalization. And if you think about the ETF market, which we do more and more as a proxy of the allocation of investors, how they're investing their assets, looking at the ETF market, the percentage of gold ETFs has actually come down significantly over the last decade relative to the percentage of when you're looking at the S&P market capitalization. So basically what I'm saying is, while the flows in gold ETFs has been staggering in terms, especially compared to the last several years, we're on pace for a record year, as Joe mentioned. If you look at that as a percentage of the S&P 500, it's actually come down quite a bit. From 0.6%, 10 years ago to 0.3% today. So where we draw that, what we mean when we look at that, we think, well, actually people are less hedged as a percentage of the equity market than they were 10 years ago, even though these flows are coming in. So I think one thing we lose track of in looking at absolute terms is what does it mean as a percentage of the overall market capitalization? And I think there's probably a lot of room for more allocation into gold ETFs if you're thinking about it as a percentage allocation hedged to your overall portfolio.
What about the fact that there are a bunch of other different ways, even using ETFs to hedge one's portfolio? Does that take share away from gold being used for that purpose?
I think it does. I mean, the ETF market continues to mature a lot, and you're seeing a lot of flows going into non-traditional strategies like buffers and other types of hedge strategies. But just purely from a gold ETF perspective, it's pretty small relative to how people have allocated their portfolios, or more likely, how professionals are allocating portfolios in terms of that total market capitalization. So yeah, we're seeing a lot of interest in these gold ETFs and a lot of flows coming into them, but it's not keeping up with the pace of their total allocation within their portfolio.
Yeah, Joe, we were talking before this just about how gold ETFs used to be primarily a U.S. phenomenon, that it was U.S. investors interested, and that has broadened internationally. What's behind the geographic diversification of interest into gold ETFs?
There's quite a bit behind it. The first thing I'd say is, while I definitely share the opinion that Mike has in terms of the allocations to gold are lower, what I would say is that looking just at S&P and just at US ETFs is not necessarily the right way to see it. The European ETF market has grown and matured dramatically, and that's probably about 35% of the overall ETF market for gold-backed ETFs worldwide. And what we've actually seen a significant amount of growth in the last 2 years has been the growth of exchange-traded funds in Asia. China, India, Japan, 2024 had record flows, now relatively small, but you're looking at a market that's growing quite substantially. Now, gold can be purchased through ETFs, but it can also be purchased in the physical sense. So it's a small component of what we are seeing in terms of portfolio allocations in the form of exchange traded funds, but don't lose sight of the fact that gold trades over the counter and physical gold ownership, which we're seeing in the investment landscape continuing to grow on a global basis.
Mike, which do you think is more likely to drive gold prices in the near future? We've got geopolitical risk, which is obviously front and center today. There's also kind of the more domestic element, whether it's the Fed decision or fiscal spending and inflation and so forth.
Yeah, I mean, I think Joe makes a great point. When you think about the gold market, just to put it in perspective in terms of what's going to drive the price, let's use Bitcoin because everybody likes to talk about Bitcoin. Right now, U.S. listed Bitcoin, spot Bitcoin ETFs make up about 6.5–7% of the total market capitalization of Bitcoin. Gold, it's less than 1%, right? So gold ETFs is a relative to the gold market capitalization, call it $20 to $23 trillion, is a very small fraction. So what we've seen over the last several years is central banks continually allocating more and more to their gold allocations, their gold reserves, which I think is a much bigger piece of that storyline. And then that, of course, goes into the trend that we've seen since COVID, where more central banks are diversifying away from the dollar into gold. And I think that's going to be a bigger driver of the price of gold than ETFs can possibly be, just given how small they are as a relative percentage of the market cap.
Yeah, and kind of speaking of the geopolitical implications, as well as the domestic concerns, there was some volatility in gold over the last week or so because of this idea that some parts of gold would be tariffed. But President Trump did state that gold will not be subject to tariffs, but the market seems to still be waiting for official confirmation from that. How does all the uncertainty impact flows and prices amid some of that whipsawing that we saw last week?
So I think it's fair to say that from the outset of the administration, gold hasn't been singled out, nor really the subject of what the president has made clear, whether it's critical minerals or minerals used in defense or telecommunications. Those items, those were the real subject of what he's concerned about with tariffs. So the market's always been expecting gold in the investment context, in the wholesale context, not to be tariffed. Now, what happened was a moment where one of the refiners out of Switzerland asked for certain clarity because of the very complicated codes that are used by customers. And they got that. And the president quickly responded by simply saying, we're going to clean this up. So that the message he's put into social media has calmed the market. And when it comes to the real underlying market itself, there wasn't very much that was really going wrong with the market. What we really saw were futures, where the gold needed to physically back those COMEX products, trade at a premium to the spot price that we basically all look at all day long, the ounce price. And that's what should happen if there's uncertainty or question. It happened during COVID, it happened at the beginning when no one knew exactly how tariffs were going to impact us. But at the end of the day, what we've got is markets back to normal conditions. Everyone's waiting for that formal clarification, which I'm sure we're going to get, but the president has a lot on his agenda today, and I think that we'll sit tight. And when we saw the clarity come around copper, it was several weeks after the announcement on copper, so maybe it'll take us a week or two. But right now the market's calm, and it's continuing to perform like we've expected it to. It's liquid, it's open, and people are able to get access without any impact from the question around tariffs.
So no complaints from you at the moment. I do have a question for both of you. The ETF industry, always innovating. What new gold-centric or gold derivative products are on the horizon that you believe are interesting? Mike, we'll start with you.
I mean, I don't think you really can change the dynamic of gold. It's a great spot vehicle, allocation vehicle in terms of, if you're just looking at the gold market, it's hard to beat a GLD or any of the other ETFs in terms of tracking the spot price. It's a great allocation vehicle, exactly what ETFs were designed to be. We've seen some strategies come out that are, writing covered calls on the ETFs of the gold themselves to create an income stream from gold, or buffer ETFs to take away the volatility. But in terms of pure product proliferation, I think it's really difficult to look at the GLD structure and find a better way to think of allocating to this as an investment other than just the pure vehicles that are out there currently.
Joe, what do you think?
I tend to agree. Regulated instruments around the globe offered in markets that you wouldn't even imagine have access to exchange-traded funds. So they are acceptable, very efficient, and very well welcomed instruments in the market. What I think is interesting to keep a close watch on is how digitization will start to develop. We've been working closely with a number of industry bodies, including the LBMA and others, and the bullion banks, to talk about tracking and tracing gold. From there, we're going to build out a better way to see what the world will look like and how it will develop if we can find a digital access to the gold market to sit next to the exchange-traded funds in the future.
Like a stable gold instead of a stable coin.
Actually, gold is, in its own right, a stable coin in the form of an exchange-traded fund, but how do you rightfully digitize it and make it easier to access, or more use cases, for example, using gold more readily in collateral or other mechanisms for institutions.
Maybe easier for anti-money laundering and...
Precisely. So right now we feel very confident about accessing the gold market with exchange-traded funds, and we're trying to find the right way to possibly unpack digitization.